Ladies and gentlemen, good day and welcome to PDS Limited Q4 FY24 and FY24 earnings conference call hosted by EY. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Ms. Reena Joseph from PDS Limited. Thank you, and over to you, ma'am.
Hello, everyone. I welcome you all to PDS Limited Q4 and FY24 earnings call. Today, from the management, we have Mr. Palak Seth, Executive Vice Chairman, Mr. Sanjay Jain, Group CEO, Mr. Rahul Ahuja, Group CFO, and me, Reena Joseph. Please note that a copy of the presentation is available on the investor section of the website as well as in the stock exchanges. Anything said on this call which reflects the outlook towards future or which has been construed as forward-looking statements must be reviewed in conjunction with the risks that the company faces. The conference call is recorded and transcript along with the audio of the same will be available on the website of the company and the exchanges. And please note that the audio and the conference material is copyrighted material and cannot be copied, broadcasted, or attributed to any press media without specific and written consent from the company. With that, I would now like to hand over the call to Mr. Sanjay Jain, Group CEO, for his opening remarks.
Thank you, Reena. A very warm welcome to all of you, and thanks again for joining us today. Before we go deeper into our operating and financial performance, let me provide some context regarding the challenges and opportunities we faced in 2023-24. It's been a kind of tough year, significant headwinds, muted demand, high interest costs, geopolitical factors across various parts of the world, impacting the demand. However, your company tried its best to minimize the impact of all of this and had a year wherein, while the industry got severely impacted, but we prevented that and only had close to about 2% decline in revenue as compared to previous year. While this could, be continue to be seen as a year of challenges, PDS also saw this as a year of opportunities. So therefore, we felt that this year would be a year wherein we will be preparing ourselves for the next phase of growth. On one hand, as I mentioned, that we successfully, navigated the challenges, but there were opportunities unfolding, and we decided to capitalize on them and started investing into them. And these efforts not only position us for growth in the coming years, but also solidify PDS as a global leader in the fashion value chain. And as I mentioned, it was a tough year, but somewhere in quarter 3, we could, as a first step, neutralize the declining trend. We almost had a flat quarter, but in the quarter 4, we had a 25% growth over quarter 3. And as I am talking to you today, we have a healthy order book of about $585 million, which is almost close to 5,000 crores. And there's a 30% increase over the same period last year. Our aim this year is to maintain the momentum of growth and profitability. Fueling our further growth, we made investment of approximately 100 crores to our P&L. In our company, which is an asset-light company, any investment that we make into future revenues is primarily through P&L, and that is where it aggregated to about 100 crores. Our investor presentation captures a slide on the specific areas where we decided to invest to pursue the opportunities. These are primarily focused on establishing new teams and expanding into new verticals across our business offerings. For an instance, under the leadership of Mark Green, a very senior industry professional who has had a long dealing with PVH, which is the house which holds dominant figure. He has come on board, and under his overall guidance, we have formed a robust team to drive our North America strategy. We are beginning to see good traction and have already made some headwinds in terms of getting on board with some, very reputed clients like Target, and also now having a visibility of increasing our business many-fold with our existing customer, Walmart. Additionally, recognizing the potential for higher margins, we also partnered with a gentleman, Damien Hopkins in UK, to supplement our brand business. Furthermore, our existing verticals like Poetic Gem, Design Arc, Simple Approach, while they continue to stay focused on furtherance of design-led sourcing business, they are also venturing into brand space. However, it is crucial to note that we remain committed to operating within the established guardrails, including maintaining an asset-light approach, managing inventory risk through pre-sold models, and partnering with credit-worthy customers. I mentioned about existing retailers also going the brand journey, then they are carefully trying to leverage the existing network that they have with the retail customers and how in a very calibrated manner they can also supply brands to them. Looking back at our strategic tie-ups in the last 2-3 years, and it gives a proof of concept to why we are pursuing these 100 crore opportunities, whether it is addition of category, addition of geography, or addition of, new service offerings to our existing customers. In fact, we have tried to give in our investor presentation a deeper insight into 3 of our such investments that we have made in the last 2-3 years. One of them was with a gentleman called Eric Liddell. In his previous innings with Lian Fung, he was handling close to 600 million plus of home category business, and we brought him on board, and it took about 2.5 years for the business to be where it has reached today, that it has actually got multiple contracts in the home category, starting from a test order of $50 million to actually sourcing the service contract of $250 million from Asta George. And now this business is looking at, eyeing on the US markets in terms of taking this product offering. So the business is already profitable. Business is already generating a handsome, return on capital employed. Likewise, with a gentleman, Gaurav Pandey, who has earlier in his previous innings with other companies have been successfully dealing with US retailers. He has come on board and has started building the Walmart business. And we are very confident that this business will also be PBT positive in this year, in about 3 years of its journey. Likewise, the third example is the CSS vertical, which is a vertical we have started in Bangladesh and then sourcing as a service for our retail customer, Asta in UK. This business is profitable from day one. It has a gross merchandise value of approximately $210 million, approximately about 1,700 crores. As I said, day one profitable, and it generates a very handsome return on capital employed, which is infinite. There is no capital that gets employed in the business, and the returns are highly value added. So if I summarize, Casa Collective, the home category business, is generating an ROC of about 47% last year. Should be doubling up in FY25. PDS Far East, profitable business, at present in ROC of mid-teens, but it's looking good. And CSS as a business is about infinite. So this 100 crore investment that we have done in a business is a gestation wherein it leads to an immediate P&L impact, but as these unfold into their real potential, these are the kind of numbers that is there as a potential. We achieved a gross merchandise value of about 15,000 crore during the year, marking a 25% increase over the same year last year. And notably, our sourcing as a service segment experienced remarkable growth with a staggering 240% increase in GMV, totaling to approximately $440 million. That's approximately about 3,600 crores. While we generate service fee from these volumes, we continue to gain a larger share of wallet with the customer and continue to deliver customized solutions to meet this evolving needs. Our goal is to foster strategic engagements with key customers and continue to provide tailored solutions to address their specific requirements. We built a robust model which has enabled us to navigate these challenging times, as is reflecting in terms of just about 2% decline and about 25% growth now in quarter 4 over quarter 3. And not only we have kind of tried our best to navigate, but we believe now we are on a path of driving our growth and profitability upwards. And at the same time, PDS is poised to make further strategic advancements by increasing its wallet share with existing customers, diversify our service offerings, and enhance our capabilities through strategic investments. Now I will hand over to Rahul Ahuja to provide a detailed overview of our financial performance. Over to you, Rahul.
Thanks, Sanjay. Good day to all on the call today. I will, over the next few minutes, inform you all about the financial performance for the quarter and 12 months ended March 31st, 2024. As Sanjay was just mentioning, we witnessed recovery in the later part of the year. Gross merchandise value increased by 19% to 4,526 crores compared to the previous quarter. The consolidated top line of 3,215 crores was a 25% increase with gross margins of around 20%. While our EBITDA of 124 crores increased by 66% with EBITDA margin increased from 2.9 to 3.8%. However, when we normalize this for our business in gestation phase, our EBITDA translates to 157 crores versus 107 crores in the previous quarter and a margin of 5.1% versus 4.2%. Our interest expenses were largely flat in spite of the increase in top line and increase in the base lending rate, which is SOFR, from 4.9% to 5.3%. Profit after tax increased by 157% to 65 crores with 2% margin versus 1% in the previous quarter. Talking about the full year, our gross merchandise value increased year over year by 25% to 15,048 crores. Our sourcing as a service business delivered around 240% growth in the financial year 24. With a consolidated top line of 10,373 crores, we arrested a decline to a mere 2% in spite of us being 8% lower in the first 9 months of the last financial year. Gross margins continued on the expansion trajectory, with us clocking 20.4% in FY24, an expansion of 360 basis points compared to the last year. Our EBITDA was 402 crores with EBITDA margin of 3.9%. However, when we normalized it for 100 crore investment in new initiatives, our EBITDA actually was 502 crores. It's important to note that we have pulled through this year with higher EBITDA of 502 crores versus normalized EBITDA of 489 crores in the same period last year. This was achieved despite an early single-digit decline in top line year over year. Similarly, our normalized EBITDA margin expanded from 4.7% last year to 5% this year. That amounted to 203 crores with 2% margin. Moving on to our segmental performance, our sourcing segment clocked a top line of 10,080 crores with a gross margin of 18.6%, an expansion of 352 basis points. Within sourcing, our design-led sourcing offering achieved a gross margin of 17%, an improvement of 179 basis points, while sourcing as a service achieved a growth in top line of 125% with an EBIT margin of 38.5%. Brand management continued its growth trajectory, registering a growth of 96% compared to last year, with gross margin and EBIT margin of 33% and 5% respectively. Our manufacturing operations reported a top line of 597 crores with a gross margin of 38%, an improvement of 206 basis points, and EBIT of 4%. Turning to our balance sheet, the net debt was 259 crores. However, in spite of the growth in Q4, we have managed to curtail our debt levels to the previous December quarter Despite the industry dynamics, our balance sheet remains robust with strong leverage ratios of net debt to EBITDA at 0.61 and net debt to equity at 0.22. With regards to our working capital days, it decreased to 7 days by the end of the year compared to 9 days in December. Excluding Ted Baker business, our net working capital days stand at 1 day. We are focused on bringing back the net working capital days to early single digits. On the capital employed front, in PDS Ventures and others, the capital employed stands at 254 crores. It is important to note that this includes 36 crores attributable to MTM gains. We are also pleased to announce that we have proposed a dividend of rupees 3.15 per share. We had declared an interim dividend of 1.6 per share in the first half. This makes the total dividend to 4.75 per share for the year, a payout of 43%. In conclusion, the resurgence of demand and the promising performance of our new ventures bolster our confidence in achieving growth in the upcoming quarters, driving steady progress in quarters to come. With this, I request the moderator to open the floor for question and answer. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone phone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use only handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Vishal Prasad from VP Capital. Please go ahead.
Hi, good evening. So, Palak, when we talk about PDS Ventures, we report mark-to-market gains. So, given the background of us thinking in terms of mark-to-market, what is our thought process behind investing in so many companies? And internally, how do we measure our performance over a period of time for these investments?
Yeah. Thank you for the question. So PDS Ventures, was started around 7 years ago as an initiative from PDS Group to look at how the industry was moving forward. There's a lot of discussion around sustainability, circularity, and new material science in our industry. So we were seeing that some of our strategic customers, were like really getting impacted. The business model was getting impacted because all the regulatory pressure coming in and all the activist pressure coming in the West that was questioning the retailers' practices on their environmental footprint. So PDS took a conscious decision that we should be part of the solution going forward, not part of the problem. So the investment we made paid huge dividends by helping us position a company strategically with various customers. So like, Sanjay mentioned, we opened the account with Target US, which is one of the largest retailers in the US, with Walmart US, which is one of the largest retailers in the US as well, Ralph Lauren, IKEA. So having this PDS venture investment had a two-pronged impact for PDS. One, we onboarded a lot of new customers who typically are not looking to add any new vendors right now to the supply chain because there are enough vendors around the world. So looking at PDS as an innovation provider, we got our account open, and these 4 or 5 customers alone could be a $500 million business for us in the next 3 to 4 years. And then with the existing customers, we solidify our position because fortunately in the global supply chain, PDS Treasury is the only corporate treasury arm structurally investing in the future on innovation. So the impact on reputation, the impact on gaining new customers and solidifying our position with existing customers was a very strong outcome from our decision to get into this activity. Now coming to why so many investments, we've identified around 4 or 5 buckets. One is material science. We are seeing that a lot of when garments go into stores, they must come from a sustainable source. So PDS invested in a hub in Portugal to basically invest in a lot of material science innovation technologies. Second is manufacturing process, how to make our manufacturing leaner and more efficient. Third is circularity in fashion. The biggest issue in the West is how
millions and millions of tons of clothing are going into landfill. So the PDS is providing solutions to our customers, making sure goods don't go into landfill, become the circular economy. And then finally, traceability transfers to a supply chain where all the US people are asking about the ginger and cotton issue. So having key investments into these 4 buckets with businesses and companies coming out of the top universities is really expanding our ecosystem globally and one of the key players where any innovation coming in fashion industry, PDS gets to see it, and then we co-invest with our customers like Walmart, Target, IKEA, Patagonia. So when these people are looking at the innovation, they contact PDS Ventures that can you guys look at it as well with them. And our check size is then small. So companies raising large rounds, our check size is going to be like $100,000 to $300,000, where the retailer puts in maximum money and the venture capitalist puts even the larger check. But then it makes us strategic with the customer, makes us long-term and differentiates us from the hundreds and thousands of suppliers out there, which no one is able to do this with these retailers the way we do it. I hope I answer your question. So we want to answer on the mark-to-market side, please?
No, I think the mark-to-market is just our attempt to mention that this is the amount of gain that has already accrued on these investments, that from a conservative accounting policy, we are still holding this into the balance sheet and not yet taking to P&L. As and when we see an opportune time to disinvest some of these, then that is the time this MTM could potentially get into P&L.
Yeah. And most of the investing we have done, I would say, are gaining in value only because, they've been backed by the right venture capital, right retail partner and PDS. So all these investors have a very strong ecosystem around them of people that will, they are being used for not only from, a seed stage or a lab stage, but also into bulk production with the help of PDS and the retail customer that are backing them, which are some of the largest names around the world.
Right. So you mentioned that we benefit out of our investments, but I understand we are not majority owners of all the investments that we do in our venture fund. So how are we able to use their IP for PDS's benefit?
That's exactly what I meant because, we don't want to be majority for sure. We want to have small investments in various companies because we are co-investing with our customers. So if a retailer's venture capitalist firm, either H&M or Bestseller or Walmart or Target is investing with PDS in these companies, then, these companies to gain traction needs to have a combination of people supporting them to move to the next level, right? So it's important that they are backed by various stakeholders, then they can be moved forward. So if they're raising like a $2 million round, PDS will invest maybe $100,000, $200,000 only, right? But become part of the cap table, but become part of the solution with the retailers to take these investments from, startup stage to the next level based on combining strengths of the ecosystem of people who have invested in these opportunities.
Okay. And the second question that I have is, I remember we were planning to invest a lot of money in the US, and then we talked about the QIP that we were supposed to do. But on our balance sheet, we have close to 600 crores, and it has been lying on the balance sheet for a long time. I mean, it ranges between 400 to 700 crores over the last 4-5 years. So there are two questions here. We have a lot of money on our balance sheet, so why don't we use it for our investments rather than doing a QIP? That is one. And second, if we are not planning to use the cash, then what is the plan for us for using the cash? I mean, why it is sitting on the balance sheet for so long?
Yeah, I think the cash is about 680 crores on 31st March 24, and when we report net debt, we net it off. This is typically the cash that is spread across various legal entities of PDS, and this is also the cash that is pending dividend distribution. What Rahul, our CFO, is as a first step trying to do is that one hand, if there is this cash, then there is borrowing on the other side. So can we minimize the borrowing by usage of this cash so we save interest costs? That is one. We also need to look into the fact that a decent part of this cash is the margin money that we give to banks because we are able to enjoy one-day working capital because we factor our receivable on a non-recourse basis. and for setting up these lines, we give margin. So this is cash margin A. This is cash across various entities of PDS, wherein endeavor is to knock it off against the borrowing, so that we can save some interest costs. That is one. And on the QIP that you mentioned, we did take an enabling resolution from the shareholders, and but at the same time, we wanted to have this flexibility of having the requisite approvals in our hand. But at the same time, our pursuit is continuing to be asset light, and at present, we do not, have a very, very sizable opportunity that we feel we need to write a check. We do have many opportunities knocking our door, but there is no pressing need to start raising capital. Enabling resolution helps. And I think somewhere, if in the near future, if resolution is till December, if you feel there is opportune time, and we also are, wanting that this step would also enable us further broad base our investor base by getting some good, institutional investors through this process. So therefore, these are the one or two, three reasons in terms of cash being there. And as I said, no pressing need to do a QIP. It's just an enabling resolution.
Yeah, one last question. On slide number, I think 19, we have given revenue breakup for top 10 verticals. So what's the currency that we have used here?
It is USD millions. So I think thank you for pointing out. We will correct it and upload it again, but it is USD millions.
Okay. Thank you so much.
Thank you. Ladies and gentlemen, in order to ensure that the management is able to address questions from all the participants in the conference, please restrict your questions to 2 per participant. If you have a follow-up question, you can rejoin the queue. The next question is from the line of Deven from Marcellus Investment Managers. Please go ahead.
Hi. My first question is to Rahul. So Rahul, is there any delay in the factoring arrangement which we were trying with HSBC for Ted Baker?
So there is no delay in the factoring arrangement. HSBC has an approved line with them currently. We are in the process of still, finalizing the integration from what the Ted Baker, erstwhile Ted Baker used to use as their ERP system, which was AX, to SAP. I think another 3 to 4 weeks from now, the testing and all should be over. And the process that is followed by the banks in UK is that they release receivables purchase or factoring only once they do an audit of your systems. That's not a practice that is followed, at least in India. So they want everything to come end to end from the system. So let's say I were to go to them today and give them a list of my receivables, they would want to trace it back to the PO level from the system. Any manual step in between, they don't do factoring. Obviously, the reasons are, they don't want to spend too much time as far as analyzing that data is concerned or any manual touch is concerned. So we are starting our testing phase of the integration in a couple of weeks from now. And that's why I said about, 4 weeks from now, we should be in a position to invite the bank to do their round of tests, post which, they will take their internal approvals to disburse the facility.
Okay. And is there any impact of the restructuring which is going on at Ted Baker level?
Alok, if you could take that and give them an update of the latest at Ted Baker.
Yeah. So ABG is in the process of finding a new retail operator because, PDS just ran the wholesale business, which is more or less stable and the head office. But the UK and the US retail partners, they're trying to replace with some of our stable companies. So hopefully in the next 1 week, there'll be announcements. We have indications who the UK partner is one of the largest retailers in UK with the, $5 billion turnover, who will be taking over the Ted Baker retail stores. So we are just waiting to sign the documents, and the announcement should come shortly. So that will give us PDS a very strong partner on the retail side. we will then invest in the business and more retail stores and concessions and e-commerce to take the business forward on a stronger footing. And similarly in the US, I think in the next 1 week, they'll have some announcement coming. So ABG is one of the highest priorities, and we are on it on a daily basis.
Oh, okay. Okay, understood. Thank you. And my second question is to Sanjay. So, Sanjay, last in Q3, if you remember, we had said that other expenses, which had increased from 170 to 190 odd crores, midpoint of both like 180 crores is the sustainable number, but this quarter the number is close to 240 crores. So we are almost 60 crores higher than the budget. So what happened here?
Yeah, I think allow me to share a full year context, and that would also help answer your question on the quarter. For the full year on a consolidated basis, in FY24, we have 738 crore rupees of other expenses, and the last year same time was 551. So the increase is about 187 crore. Now, how do we break up this increase? There was no Ted Baker last year, and this year in the other expenses, Ted Baker has contributed 111 crores. And then Gary Weber complete sourcing solution business that we took over in Germany, it was not there last year. The 8 crore of other expenses got added up from Gary Weber. That's 119, Ted Baker and Gary Weber. The new verticals that we have mentioned that we've invested 100 crores, the corresponding previous year was 22 crores of other expenses in the new verticals. This year it is 69 crores. So the increase is 47. So 111 plus 8, 119 plus 47. That is the kind of not apple to apple. New verticals, Ted Baker and Gary Weber. If I exclude this, then the like to like last year number FY23 was 529 and this year it is 550. So the increase is actually 4% in the other expenses. The number is looking higher because we have added 2 new verticals, Ted Baker and Gary Weber, and added numerous new verticals in terms of growth strategy. That's the like-to-like comparison piece.
Okay, understood. And final question, so in Q3, the employee cost was around 270 odd crores, and that included, I think, a one-time bonus or incentive of roughly 25-30 crores. But we haven't seen sequential decline in employee costs. So is there anything? What's the reason for this?
Yeah, in fact, some of these questions that you asked us have enabled us, kind of look deeper. And as I answered on other expenses, in the same manner, the employee cost is 984 crores in FY24 and was 761 last year. That's an increase of 223. Now, in the increase of 223, there is Ted Baker 65, there is Gary Weber 22, and there are new verticals. The employee cost was 32 crores in FY23 and it is 95 crores in FY24. That's approximately 60 crore increase. Then there is North America is about 7 to 8 crores. So if I exclude this Ted Baker 65, Gary Weber 22, new vertical 64, North America about 7 to 8, the increase is 66 crores from 730 to 795, which is a 9% increase on an overall basis, which we believe is the normal increase given small increase in headcount and an overall inflation or so. So that's the answer to the question in terms of, how we are explaining the employee cost increase.
Understood. Thank you so much.
Thank you. The next question is from the line of Pritesh Chheda from Lucky Investments. Please go ahead.
Yeah, hi. Just to the continuation of the preceding question. So then this Ted Baker account, what margins is it making at the reported level for us?
So Ted Baker, Rahul, I'll try and take that question. For the full year ended March 24, we did about 507 crore of top line. We had a gross margin of about 41%, And in terms of PBT margin, it is approximately it's about 28 crores of PBT. That works out to little less than 6% of PBT margin. So that's 41% gross margin, 6% PBT margin.
Can you give the EBITDA margin?
EBITDA margin of the business is about close to 6.5%.
And how much have you invested? Because when I'm looking at your cash flow statement, I can see trade receivable 570 crore invested into, 160 crore invested into property, plant and equipment, and 158 crore invested into acquisition of non-controlling interest in subsidiary and all these places. So that's totaling about 160 plus 160, 20 plus 570, about 800 crores. So how much did Ted Baker attract investment from your side?
It is circa 150 crore. That is the amount of check we wrote to begin with, and subsequently we did recover part of the investment through working capital squeeze. So if I'm giving an approximate number, I think the 150 is down to close to 100 to 110 crores. So 40 crore got squeezed. But today the answer is 150 is down to little less than 110, and on that our EBIT is 33 crores. You're asking about EBITDA, and the EBIT number is 33. So it is approximately a 30% ROC on the last year performance. And I'm counting 33 is from June end onwards, so June beginning, May end. So therefore, I'm not analyzing it. For the period that we were holding, it is 33 crores of EBIT on the business, and the net investment as on date is approximately 110. That's the metrics of the investment decision.
And from your cash flow, if you could tell why has the trade receivables increased so much by the year end at 570? And what are these other two investing that you have done, 162 crore in property, plant and equipment, because you haven't done this kind of a capex earlier, and the consideration paid for acquisition of non-controlling interest of 150. So what resides in these 900 crore of cash flow items?
How you want to take that, then I will chime in.
Pratish, your first question was, if you could just repeat the first part of the question. Pratish, if you could just repeat the first part of your question.
So I'm looking at the cash flow. There is change in trade receivable 570 crores. So that's a fairly large number. And, so basically the question is from cash flow generation, you said. The cash flow is low in generation because there's a 570 crore receivable for no growth in sales. And then on the top of it, you have invested about 320 crores in a property, plant, purchase, equipment and acquisition and non-controlling interest. So if you could explain what all is this?
Sure. So as far as the receivables is concerned, a large part of the receivables increase is on account of the Ted Baker business, as well as a few of our large customers increasing the number of days as far as payment days are concerned. So both these led to an increase in the overall receivables number as far as this year is concerned. As far as your second part of the question, which is around investment in property, we last year had liquidated a property in the UK. Our three large businesses, which is Poetic Gem Design Art and Ted Baker, all work out of rented premises, and particularly Poetic Gem, which itself aspires to be $1 billion business in the next 4 to 5 years. So there was a need for us to have a better office. We were operating out of more like a warehouse come industrial area in Watford in London, and we invested about $10 million in acquiring a property which we feel will be appropriate for the size and shape of our businesses in the UK and also the customers that we handle in the UK. So we thought that this investment was required during the year. So that's where we invested about $10 million in this property in Watford in London.
So that still explains out of 320 crore, $10 million, which is about 80-90 crores. So you have 162 crore invested in purchase of property, plant, equipment, capital work in progress, and investment in property. That is 162.
Sure. Pratish, $10 million, as I said, about 90 crores is this property. Including tax and all that you have to pay, it is overall comes to about 11.5. So let's say 100 crores in this property. We do about, every year across our verticals, about anywhere between $6 to $8 million of capex. This year, it was slightly higher because one of our businesses, third largest business, which is Simple Approach, set up a sampling unit in Bangladesh, which led to a slightly higher capex than what is routine. So about $9 to $10 went into capex, and our PDS venture investments in any year are around $5 to $6 million, which is basically calls coming from the existing investments that we have done, plus any new opportunities. So we usually restrict it to around that level. So all of these put together, and including a small capex in our Sri Lanka operation, all of these put together add up to another, 180-200 crores.
So this 158 crores is those PDS venture investment, which is usually about $5-6 million.
No, that will just allow me to.
PDS venture is not 158 crores.
Sorry, allow me to chime in here. I think in the order of the question that you asked, firstly, the receivable, as Rahul explained, went up.
I understood that. I understood the purchase of property.
Yeah, just allow me to, address all these points. While the receivables went up, the corresponding payables also went up. If Ted Baker we exclude, the net working capital is 1 day. Typically, we manage 0 days, 1 day's net working capital. So in our business excluding Ted Baker, we are bang on there. Any increase in receivables is also corresponding managed through payables. So no increase there. Rahul answered that we had a 60 crore capex in years FY23, and we have a capex of about 167 crores, with almost close to about 110 crore increase. And he answered that about 10 million, which is about 85 to 86 crores, including some taxes, went into the UK property. What the remaining amount that is there is the capex, that 10-15 crore remaining is the capex in the sampling room of Simple Approach in Dhaka, is the capex in Sri Lanka. So that's the explanation. So capex is in line with what happened last year, except the investment in the UK property. And in fact, we have invited our investor community to be part of the Investor Day on 11 June, wherein we have invited all the business heads from UK to also be present, and they are very excited themselves to scale up the business to $1 billion from about 400 million right now. In terms of the venture tech investment, we invested close to 70 crore in venture tech investment last year in FY23, and as we see for cash flow, the investment is about 29 crore in venture tech investment. And in respect to the Ted Baker, we mentioned about 150 crore. That's part of the acquisition of Ted Baker 155. I think the venture tech investments are down. The capex is in line, plus the addition of the UK property, and the 150, as you asked earlier, was in the Ted Baker business.
Okay. So that 157 that we see is all Ted Baker investment.
That 52 crore, yeah, the acquisition of PDG, Nobles and others, that 155 crore number that you see, it includes Ted Baker. We also mentioned in one of our releases that in a factory in Sri Lanka, which is making an EBITDA of about 15 crore, we invested about 1 million, about 8 crore to get a 26% stake in that business. So that's also captured here. That 8.5 crore to buy a 26% stake in a factory in Sri Lanka with a EBITDA of 15 crore is also captured here.
And sir, from your opening remarks about this interpretation of adjusted and the reported margin, how should we interpret now this for FY25? And when you say that you have started your order book at $585 million, which is plus 30% YOY, how should we interpret it for your future for FY25? Now, this 585 will also have, I don't know whether it's a GMV value, how it is. How should we interpret this number with your revenue performance, purely your revenue performance, and the margin adjusted reported for FY25?
See, on the margin, as we have mentioned by giving the 3 sample actual cases of CASA Collective and PDS Far East and CSS. It takes about 2 to 3 years from the investment phase to these businesses becoming to their full potential. And given that FY24 was a year of large investment, relatively large, so we will continue to report normalized EBITDA to enable our stakeholders to see this. But in about FY26, I think we should start seeing significant benefit coming in from these investments. It can be sooner, but that's therefore the normalization impact we have to capture in FY25 as well. That is answering your first point. In terms of the order book, when we're talking about almost a 30% growth as compared to the same period last year, this is the order book which is equivalent to the way we book revenue. This is not that we are saying that this is a $585 million circa number is a GMV number. This is what actually is the number that gets booked into revenue. We've mentioned a 10% year-over-year kind of outlook that we are seeing ourselves. Currently, we are very positive with the order book in hand, 30% up. But I think we are a bit cautious given the overall environment. But at present in hand, the order book is much better than the 10% that we are aspiring to grow the year with.
When you said normalized margin, you're normalized.
Mr. Chheda, maybe.
Sir, I just want to finish this question. When you say normalized margin, you mean normalized margin of FY23, which was 4.5%?
Yeah, we have done apple to apple. So when we have given normalized EBITDA of 4.7% was in FY23, and the corresponding number is 5% in FY24. And the only main exclusion to arrive at the normalization is the investment in new verticals. Nothing else.
So if I have to understand your comment properly, you are saying that FY25 we go to the normalized margin number of FY24 as the reported number, and then whatever increments we see thereafter.
Yeah, I think firstly we would request, we are very happy to get all your questions, and we would really request if we can have a one-to-one meeting to get deeper so that we can take more questions. But taking this as the last question, yes, our endeavor is that whatever is the normalized EBITDA for FY24, we should target to achieve that as the EBITDA from normal operations post the investments.
Oh, thank you very much, sir. Thank you.
Thank you. The next question is from the line of Chirag Fialuke from Ratnatraya Capital. Please go ahead.
Hi, good evening. Thank you so much for the opportunity and congratulations on the traction on the top line. Just 2 clarifications. So Tech Baker this quarter was around 162 crores. Is that correct?
Yes.
And could you just share the same number for sourcing as a service for this quarter?
Yeah, we will just that. We'll answer that in 1 minute time. If you have any more questions, sourcing as a service for the full year that we have booked as a revenue, and Leena will just help fill out the quarter number. It's 215 crore out of the 10,373 crore revenue that we reported. The sourcing as a service and agency is about 215 crore, and it was 66 crore in the same period last year. Quarter 4 number, I will just come back to you as we take more Q&A.
Perfect. So 215 crores is the total for the full year for sourcing as a service, just to confirm, right?
That's right. Commission income from sourcing as a service and the agency income that we get otherwise was 215 crore for the full year against 66 crore in the previous year.
Perfect. Understood. Thank you. Just one clarification question. I think previous participants also sort of were trying to get around to this. The page number 31, which is the FY25 outlook on the presentation, you talk about 10% top line growth, which you're saying is sort of mildly, being conservative a little bit based on the order book, but given the environment. What is puzzling is more the profit growth. A 15% PAT growth would mean a far lower margin still in FY25. Is there a plan to continue investing through the P&L for new ventures, or am I missing something? Could you just talk a little bit about sort of profitability for FY25 a little bit? Is that possible? Thank you.
I think you have to permit us to be a bit conservative. We want to make sure that we are in a position to try and beat these estimates that we have for the year. And our endeavor is to improve the margins, going forward as well. But as I said earlier, the verticals that 100 crore that we have invested will continue to be in the gestation. But on an overall basis, to answer specifically your point, we achieved a PAT of about 2%, and I think we will endeavor to improve it for the year on the whole. If that means more than 15% growth, then that is what we will strive towards. We're not anticipating the PAT margin to decline going forward.
So FY25 may add here that, the market, as we mentioned at the start of the call, last year, the market conditions were very challenging, very tough in the markets we operate in. And while we have seen good amount of recovery in Q4, and we expect the trend to continue, but we'd rather be conservative, wait and watch for a couple of more quarters for both top line recovery and bottom line margin expansion to start happening. So it's still not, a situation where we can, get aggressive and say that we will deliver an X amount of growth in bottom line. We will rather be conservative and wait and watch for the market to bounce back.
Understood. That's clear. Just so that, my question is clear. So if I look at the page 21st of the presentation, if in general you guys think of 30 crores as an investment in new verticals, in FY25, do you anticipate investing a lot more than that, or is it going to be around the normalized range? I think that's the only thing that's kind of under our control. The rest of the environment, whatever happens, happens. But what do you anticipate as investment into new verticals for FY25 broadly?
I think 2 points to clarify. Firstly, on the previous observation or question, 10% growth in top line, 15% targeted growth in profit. When the profitability is improving at a higher percentage, clearly indicates a better PAT margin. If we were at 2%, with these kind of numbers, we should do better. That is point number one. We have invested about 100 crores. I think our focus this year would be that let us retrieve more value from the investment we have made. So therefore, at this stage, we are anticipating to bring this number down. We will continue to keep investing, but if I have to prioritize, let us harness what we have invested into rather than committing more. So therefore, this number should gradually, sequentially come down.
Understood. Fair enough. Thank you.
Thank you. The next question is from the line of Lovish Soin from Phoenix Advisors. Please go ahead.
Thank you for the opportunity. My first question is that despite the accelerated investments in the US market that we have made over the last few quarters, it seems like the revenue from North America business has declined 15% year-on-year in FY24. So what is the reason for such a degrowth despite these investments, and when would our efforts in US start to produce tangible results?
I will also request Mr. Palak to allow me to firstly answer the number part, and I'll request Palak to add in on the US strategy. I think hitherto we were catering to North American market, sitting from where we are, whether we are in UK or Hong Kong or in Bangladesh. It is in this year that has just gone by that we actually created a strategy that let us invest into senior resources with relevant experience. Let us have people on the board, whether it is at the board of directors or whether the senior people employed with us. So that is where we believe that, it was a tough market for US. We all are aware of the inventory issues. We all are aware of the overall high interest rate and low sentiment environment. So, but now that we have invested into these people, we've got, camp on the ground. That is where we are very bullish on, scaling up this number. And I'll request Palak to please add in terms of what is the game plan and strategy, please.
Yeah. So overall, US inventory levels are extremely high last 12 months. They started normalizing in the last, during the Christmas period. So this year we're seeing the bounce back of demand coming from customers. If I speak to most of our customers and, the competitors, they were looking at almost a 30-35% decline. on the buying they were doing last year versus the year before. So now situation has improved, but PDS in the last 12 months has onboarded some of the largest American retailers as customers. So Sanjay mentioned about Target US, which has got a $50 billion apparel business, Walmart US, Kohl's, Lands' End. So some very big American customers have now chosen PDS as strategic vendor, and we feel that the investment in the quality of people we are making is going to facilitate huge growth of that business in the next 12 to 24 months. Walmart had a summit in India. They came to India in, I think, February, March this year, and they met almost 65 vendors to talk about strategy and growth. And only one vendor was invited back to Bentonville, which was PDS. So out of 65 evaluation of different companies they did on the apparel side, PDS was the only company that was invited back to Bentonville, where we went and met them last week, and they're asking us what is our 5-year vision with them. So our 5-year vision is forecasted that we want to do $400 million with Walmart in 5 years' time from now. So they're the kind of discussion we're having with these retailers in a time where vendors are being consolidated. And it takes time, right? Everything takes time. Opening the account is the first step, and then so discussion with senior leadership is second, and then investing in the right team to make sure that all the discussion happens, gets into business that can be executed is the third. So we've taken all the 3 steps. And hopefully by H2 this year, we'll see our US business start picking up and orders flowing in. So the real impact will come in next financial year, but this year already green shoots and, all the positive news that started flowing in. And H2 we'll see big upswing on the business in the US.
Got it. Thank you. Just follow up that, given that these large customers you mentioned, Walmart, Target, and Kohl's, already have their on-ground sourcing teams in Asia. So how big can PDS become as a part of their overall sourcing?
Because the sourcing teams are the ones who are putting PDS forward. Our interaction with Target US is through the Bangladesh office, because they only work with 4 vendors in Bangladesh. Today, in my view, if you are a factory in middle of Asia, be it in India, be it in Bangladesh, be it in Indonesia, be it in Vietnam, has zero value to a customer. There are 10,000 factories globally. No one is interested, no retailer is interested to talk to another factory, to honor another factory and do business with them. The only thing they're interested is every retailer has got pressure of margin, design, FOB LDP, sustainability, circularity. So there are a lot of things the retailers are facing in the home market where they need to align with strategic suppliers to be able to fulfill those objectives. That's why Target US said that they valued 180 vendors since COVID. PDS is the only one that got added. And PDS doesn't even own large factories, but because of the element of design and the entire investment we have done in our whole sustainability and circularity side, this is number one objective from Target, how to make the supply chain more sustainable. They say to the company, based on all the investments they have made, to provide them solutions on that journey. And that's added as a vendor. If you look at Walmart US, there are 3 strategies from the CEO's office last 2 years, which they are now in their 5-year plan. One is made in India, other is made in USA, third is sustainability of supply chain. So PDS is ticking almost all 3 boxes. Made in India, we did a partnership, like a joint venture with a factory in Mysore, which we have put forward. Made in US, through our venture arm, we have a company called Unspun, which now is putting plants in the US. Obviously, it's a small investment from PDS, but that company is now partnering with Walmart to set up some manufacturing plants in the US. And third, on sustainability side, they see the solution we are providing is very, very, important for how they are looking at their own supply chain going forward. So the local office of these retailers are the ones talking to PDS and putting us forward as a solution provider to the head office in the US.
Thank you. Yes, that does. Thank you. Just one last question from my side. With 10% revenue growth in FY25, the ask rate for FY26 and 27 to meet the 2.5 billion revenue target in FY27 that we set a couple of years back is very steep. So how confident that we'll be able to achieve that 2.5 billion target in FY27, or is there a deferment to that, or are we deferring that plan for now?
As Sanjay mentioned, we already have a 30% uptake on order book compared to last year, which is very few companies can say this in our industry. Still, the industry is highly challenging. There are a lot of companies, a lot of suppliers going out of business, a lot of retailers consolidating. So in that consolidation, if we are seeing a 30% growth in our order book on H1, which is a positive sign. So, but as we said, also to be conservative, we are giving guidance of numbers which we feel, because we don't know what happens in H2, but overall situation looking quite positive. So hopefully, we will obviously beat our guidance for this year as well.
And that we are continuing with that 2.5 billion revenue target for FY2024.
I mean, yes, this is the plan, but PDS will not take any unnecessary risk to its business model, to force anything. But yeah, the kind of opportunities we are seeing and the customer engagement we are having, we can easily see, a lot of growth being projected by existing customers. And so the discussion happening with most of them.
Great. Thank you for that answer.
Thank you. Ladies and gentlemen, we would take that as our last question for today. I would now like to hand the conference over to Mr. Sanjay Jain for closing comments.
Thank you so much, EY team. Thank you so much, our investors, for joining, our stakeholders for joining this call. We would welcome that if anyone wishes to have a one-to-one conversation at group level, we are available. We have also sent you a save the date for June 11th in Geo Center BKC. We are hosting our Investor Day. We are inviting our top 5-6 business heads who are flying in from various locations to get an opportunity of meeting you and vice versa as well. So kindly do join us. Our Investor Day will be emailing the complete agenda by the end of this week, and we look forward to your participation. Thank you so much. Thank you, everyone.
Thank you, everyone. Thank you.
Thank you. On behalf of PDS Limited, that concludes this conference. Thank you for joining us. You may now disconnect your lines.